On the heels of the recent banking fiasco, it looks like our economy is a little bit bored and confused. The biggest obstacle coming up for the economy itself seems to be self imposed, the debt ceiling deadline in Washington, everyone's starting to talk about. It looks like the consumers finally tapped out as car repossessions have nearly tripled in the last few months. And mortgages are boring and stuck in the 350 range, which is not a bad thing. The reason for this is we're not having a banking crisis, but the current crisis we're having right now is in banking. Welcome back to This Week in Mortgage, everybody. My name is Sam Battaglia, your favorite mortgage broker in California here at Mortgage Black in Beverly Hills. I hope you had a great week. All right, well, the economy, coming off the heels of the banking fiasco, is a little bit bored and confused, which is okay. The boring part, the recent jobs report we talked about last week, came in line with expectations, not too hot. Stocks, for the most part, have mostly been sideways. A little bit boring as well. And here's the confused part. 3-month treasury yields, 5.2% roughly. That's an insane level for a 3-month T-note. So it's at a 22-year high right now. And it is actually about 170 basis points higher than the 10-year treasury note. So in the 3-month treasury note, I hope I said 3-month earlier, not 3-year. The 3-month treasury note is at 5.2%. And the 10-year treasury is around 3.5%. Big inversion, big problem. And right now, the only thing certain is a lot of uncertainty on the way. Moving on to the debt ceiling in Washington, speaking of this uncertainty, the government needs to raise the debt ceiling to continue operating normally. And this raising of the debt ceiling is not forward-looking. This is looking in the past, and this is to pay our old bills, not new ones. So we could actually default on our debt as a country. And this happened, I want to say, back in 2011. It was built up to be a bigger deal than it actually shook out to be. But I think this time could be different. Now, sometimes on Wall Street and in the economy, good news equals bad news. Sometimes bad news equals good news or nothing. I actually can't predict what'll happen if we default on our debt this time around. I doubt things are going to stay the same. And who knows what's good and who knows what's bad. But I do know this creates a lot of uncertainty. And the odds right now of a default on our debt, as I mentioned, are very high because nobody in D.C. can play nicely in the sandbox with each other. Moving on to the U.S. consumer. Looks like the U.S. consumer is finally tapped out. Car repossessions have nearly tripled in the last few months. I saw this week. And financial institutions are preparing for some defaults on cars, credit cards, student loans, anything else that they lent out to the consumer if they are smart, and hopefully they are, and hopefully the regulators are making them stress tests for these defaults. Because as we know, the U.S. consumer is 70% of the economy. And from there, the world economy plays off that. And as I've been mentioning for the last couple years, when everybody was on TV saying that the consumer was healthy and the banks were coming out and saying savings accounts were at all-time highs and credit card debt were at all-time lows, the one thing everybody forgot to take into account is no one had left their house for 2 years when they were making those statements. Now that everybody's out and about again, the consumer's broke again, and that's just the bottom line. There was no way to measure things on a traditional level coming off of the 2 years for good, bad, or in the middle, because everything we've been dealing with is clearly unprecedented. But I can tell you this, the Federal Reserve, by raising these interest rates, has really done a number on the U.S. consumer. And this recession, rolling recession, whatever you want to call it, self-fulfilling prophecy at this point. Moving on to mortgages and housing. All right, a little boring here on the yield on the 10-year, about a 350, give or take 10 basis points for the last few weeks. And as I mentioned, we're not having a banking crisis, but we are having a crisis inside banking. And the way to think about this is when lenders and banks and organizations are looking to make loans, the stove is a little hot right now, and they don't want to touch it and get burned, so to speak. So rates are not really reflective of the yield because there's a little bit of uncertainty, well, a lot of uncertainty, but they're artificially high to hedge for risk and unknown risk. So it's basically a hot stove right now in lending. All things equal, as things settle down, if yields stay the same, rates will temper down as well. And I have a prediction actually moving forward, and I don't know how this is avoidable. There will be a commercial default or 2 or 3 or 10 shortly, unless the workouts get done quick. That will take down another banking institution or two. I'm not sure who, I'm not sure how big, and I'm not sure when, but the headlines of the commercial space, especially office, which you've probably seen on the news the last couple weeks, as I've been mentioning for the better part of a year now, the office to residential conversions have started to begin. Okay, everybody, that is my show for this week. Friday, once again. Please have a nice weekend. Take care of each other. Any mortgage-related questions, please don't hesitate to reach out to me. Thanks as always for watching, and have a wonderful weekend.